the stock. As you very rightly said that CVK Kumar has a very strong experience within the company and has been heading one of, their most important vertical, that is IMS. So we see this as a very important move for HCL Tech.
Nikunj, Aisha, I'm sure you have more numbers as well, but just to brief you, I think the revenue is by and large in line. I mean, we were anticipating about a 2% uptick. It's 1.6. So in a manner, yeah, it is slightly a small miss, if you will. Maybe they'll talk about covering up in the second half, but the bottom line number is not that bad. 2014, our estimates were 1968. So I think the bottom line cut is not as strong as we were anticipating. The only thing is that despite this quarter having that little bit of a miss, if you will, they are reiterating their guidance, which is actually a good thing in a line when everybody else has kind of shown that the numbers might not look that great in the second half. I think this company is going out and doing that.
Understand some points here. If they have not cut their guidance, Neeraj, which means they will grow in the range of about 12 to 14%. You track HCL Tech more, so which means that they will grow in the range of about 12 to 14%. Yeah. Now, if I look at constant currency, 12 to 14%, yes. HCL Tech is the only large company which is talking about a double-digit growth. Infosys is struggling with single-digit. TCS will struggle to deliver even a 10% growth. So you do have a situation where HCL Tech, after a good Q1, has come out with a good Q2. And here's one large cap IT company which is projected to grow at a double-digit growth rate, which is better than Infosys and TCS, and which could be highest in the industry. So I guess markets, Neeraj, will have to take notice of that HCL Tech is growing at a run rate which is actually a good 30-40% higher than the industry average. You know, Neeraj, one is doing an absolute comparison and second is doing a relative comparison. So both an absolute comparison and a relative comparison, I think HCL Tech currently is on a higher pedestal.
Plus, I think Nikunj, we were talking about this yesterday, that the valuations are not that sky high. It's come off quite significantly from the kind of P multiples that it was trading at. So I think maybe in terms of pecking order for a lot of our analysts, this could actually turn out well, because yes, you are right. They are reiterating the guidance, and probably the only large cap IT company right now. We don't know what Wipro will say. Suffice to say, they will probably not do this. So only large cap company right now to do this. Urmil, what's the? Sunita is ready as well, but Urmil, just a quick question here. With the reiteration of the guidance, they have had this small, if you will, a blip in the quarterly expectation versus delivery, but they've reiterated their FY17 guidance. What's the pecking order for you right now, considering that they are saying they'll grow at double digits?
Yeah, so this it's a slight miss for this quarter, and it happens because there are significant large deals which are at the transition phase. So a quarter or so, and the miss is not significant as well. As regards the pecking order, HCL has been one of our top picks amongst the ID large cap. We have a buy recommendation on this stock and a target price of 937, which is based on 15 times on FY18 earnings.
Okay, I'm just looking at large client deal wins as well, guys. They have had about $100 million plus client, $250 million plus clients. I'm guessing the TCV should be in what they've done in the previous corresponding quarters as well. They're talking about the IBM partnership as well, IP partnership, to cover a bunch of other services. And this is something that we would want clarity from with regards to the IP deal. But Sunita Nagpal is with us as well. Sunita, anything else that you're picking out?
Well, as far as the numbers are concerned, I beg to differ with you. The numbers are slightly better than expected. We were expecting 2.6% growth in constant currency. They've done 2.8%. EBIT margin performance is better than expected. So clearly the utilization benefits or some productivity gains have